What's up, guys? Jeremy here, your favorite financial advisor and financial coach. If you want to join my free financialpreneur community, or if you want any feedback on anything related to your personal finances, or if you're looking for a money manager, head on over to jeremybr.com. This video is not financial advice. This is just education, infotainment, if you will, although that might be trademarked by Patrick Bet-David. So, today, what I want to get into is just the tip of the iceberg of a series of videos that I want to make about GameStop. And the theme of this series is GameStop is not a meme stock. Okay, that's really what I want to get at here. So in a second, I want to share my screen. And in this video, we're just going to think about one way, one angle that you could go about valuing a company and taking that into GameStop's point of view, and you can decide for yourself where you feel like the fair valuation belongs for their company. So let me share my screen here. And here we are. So right now, GameStop is trading at $23 a share. Based on their float, that gives them a market cap of a little over 10 billion. They have on their books over 6 billion in cash and securities, giving them a price to book ratio of 1.6. So, valuing GameStop by their price to book. Some ways to think about it. So, price to book, your book value is your net assets. So, your assets minus your liabilities, that's your book value. GameStop's at a 1.6 price to book. This is not the only way to value a company, and we will have more videos coming out. But for this video, let's just say honed in on this price to book thought exercise. So in the retail industry, the average is 8.43. So if you were to take GameStop's book value and apply just the retail sector average price to book earnings ratio, GameStop would have a market cap of 54 billion. Is that making sense? Are you understanding how this works? So if you were to take the Best Buy price to book ratio of 5.5, GameStop would have a market cap of 35 billion. This is without them changing anything about their business. This isn't them becoming better or growing more. This is just how do we value their book? And right now you can see their book is severely undervalued compared to some industry benchmarks. So some things to think about with price to book ratio, like why would any company have a higher or lower price to book? Well, let's start with Best Buy. So some companies might have a lower price to book relative to their industry average, right? So here's the industry. Every industry is quite different. Like manufacturing, energy, banking are are unique in that they have very low price to book ratios as an industry. So it's great to start with the sector that you're looking at specifically and then say, okay, how would you create relative overperformance or underperformance compared to just how any given retailer might do? On an underperformance perspective, you have a company like Best Buy, and I would say they are underperforming in large part because there is not a lot of clarity about their financial future. Their net income has been on the decline for several years in a row, and it's not really clear how they are going to turn that ship. So their book is not going to be as highly valued because there might not be as many buyers or suitors for that book. Now, Walmart, for example, is a highly valuable business, but they have a ton of assets. So relative to the retail industry average, Walmart has so many leases under contract, so much real estate to their name, right? That there's just so many assets. The book is so large that the multiple from that base isn't going to look as impressive because that base is so big. And now you have some overperformance, and we'll use Chewy as an example here because they are an online retailer. Their price to book is almost 50. So they're valued at almost 50 times their book. And the main thing to know about Chewy is they don't have any stores, right? Their footprint is so low. So their book, their base is so low. They also do not have a ton of cash on hand like GameStop does. So that, again, it shrinks the base that you're using as a multiplier effect to value the company as a whole. So if GameStop had, if their book was valued the same way that Chewy's book is valued, then GameStop would be worth $321 billion. Okay, then you have AutoZone here to 13.1. They have probably a typical sized footprint, a typical sized book, whereas Walmart would be a very large book, Chewy would be a very small book. AutoZone, the overall footprint of the company might be relatively standard, and I'll show you that in a second. And they're in an industry that has a relatively high level of clarity as it relates to maybe some other retailers, which maybe are more heavily leaning on consumer discretionary, especially like clothes retailers or jewelers, etc. You could see how an auto retailer might have a little bit more desirability related to how well can I count on that business to stick around. Well, now let's think about GameStop for a second. And you don't know everything about GameStop, so we're going to have to keep making more videos. But the video game industry as a whole is an incredibly resilient industry. So much more resilient in terms of a consumer discretionary spending category than almost any category, furniture, jewelry, clothes, etc. And yet their price to book is so low, so low. Like it's almost like they are priced as if their industry is incredibly um, uncertain. When the truth is, their industry as a whole, the video game industry, the video game sales is one of the largest industries in the world. A great industry to be in. So, what else could we think about? Why would their price to book be so low? Well, could it be that they have a very large base? You know, is it more of a Walmart situation where they just have so many assets? Their book is so large that it deflates their pricing. Well, they do have a lot of cash, but I would say even with that factored in, no, their base of assets, their base of book is still quite low compared to a Walmart, for example. So the real reason why they might be valued this low from a price to book is if people feel that a bankruptcy is imminent, like compared to other companies, there's just no way this company will exist. And yet, this is a company with no debt that is actually already profitable as a company and increasingly profitable from a net profit perspective and even from an operational profit perspective. But I'll save that for a future video. So it's not going anywhere, it's not declining. The book is small relative to a Walmart, and the clarity of the industry is high relative to maybe, say, a Best Buy, for example, and the financials are strong. Check out over here. This is just a little Google searching I was doing, trying to estimate what is the size, the scale of these retailers. Okay, so Best Buy is sitting at about 41 million total square feet. If you add up all their stores, they've got over 41 million square in square footage. AutoZone in a similar ballpark, 51 million. Okay, major retailer servicing a lot of the United States. Walmart, they're way over a billion in total lease square foot. So future lease obligations, this is one of the liabilities that goes against or that factors into your book value. And then inventories, right, to supply all those stores, etc. Then you've got Chewy at zero, right? They have no square footage lease. Then you have GameStop. So who is GameStop most similar to? In 2024, they're at 5.4 million total. And by the end of the year, they'll be closer to 3 million because they are aggressively closing more stores. So their footprint is is much closer to Chewy's footprint than it is to Best Buy's or certainly to Walmart's. They really are shifting more and more to become an online retailer. Just like, for example, Chewy. And Chewy was founded by the current CEO and CIO and largest individual shareholder of GameStop, Ryan Cohen. So his bread and butter is e-commerce. That's the company that he built from the ground up, Chewy, and then sold to become a billionaire. And now he's several years into riding the ship at GameStop, and lo and behold, they have half as many stores as they did when he started. And in the next year, they're going to have half as many as they have right now. And is it because no one wants to buy their stuff? No, it's because they are getting efficient in the utilization of their assets. They're getting efficient in what is their total liabilities, what are their total assets, how do they make the most of it? And they're mimicking more closely an online retailer than they are traditional retailers sit with high costs of doing business. And yet they have high clarity in terms of their future longevity. So the clarity of the future would usually increase the price to book of a company. The lower the um, the lower the asset base required to operate, the more efficient that you operate, usually the higher the price to book would be. And yet in both cases, GameStop is multiples lower in their price to book compared to some of these industry comparisons. So ultimately, where you feel like GameStop's book is fairly valued is up to you. But is 1.63 a doom and gloom type of price? Is that the best valuation? Is that the most accurate? Or is 321 billion the most accurate? What do you think? From a per share perspective, by the way, if GameStop was valued according to these price to book multiples on a per share basis, if they didn't raise more equity, here's where they would be sitting anywhere from a 340% return on the low end to a 3,000% return on the high end. And who do you think they're more like, Best Buy or Chewy at the end of the day? They're probably somewhere in the middle. So let's just say they're industry average, even though they are most certainly more efficient than the industry average and most certainly have a higher level of financial clarity than the industry average. So I would say most likely they're probably long term going to end up somewhere between an AutoZone and a Chewy as far as their fair price to book valuation. That's going to put them anywhere from a 84 to 321 billion dollar valuation based on their current market cap and current book. But their market cap's going to change, and so don't get too stuck on these specific numbers. It's somewhere in this multiple range, maybe a 19 long term that I think GameStop could achieve because ultimately they maybe don't have quite as sticky of a customer base as an AutoZone, but they also have fewer competitors in the retail space. And we'll save a little bit of their fundamental analysis for future videos. But here's a key point to consider. The market cap threshold for S&P 500 inclusion is a $20.5 billion valuation. 20.5. So right now, they are underpriced by, you could say, at least 340% on a price to book basis. And yet, not even halfway there, they will already be eligible for S&P 500 inclusion. And if they're included in the S&P, well, there's so much money that's going to come into their share ownership because there's so many people that just invest in the SPY. And so that in itself becomes another tailwind, another boost to their price to book multiple. It makes their book that much more valuable. It makes their future that much more certain. It gives them that much more equity by which they can make that many more moves to improve their business. Right, so just where they're at right now, no doubt they're undervalued. They're being priced as if they have incredible uncertainty and as if they are incredibly overburdened by assets, when in reality they are leaner and meaner than almost anyone in the entire retail sector, a more efficient use of capital than almost anyone in the sector, and a higher level of financial clarity than almost anyone in the sector. And you might disagree with that second point for now, but we'll get to it in future videos. Another key point I want to make, GameStop's GameStop's assets, right? It's not like real estate, or it's not like a whole bunch of inventory, some other things in your asset base that could create a large base of assets that really, as a company, the only way you can monetize it is through continuing to operate as a company. GameStop's assets are substantially inflated by cash, just cash in the bank. So, what am I trying to get at here? The value of 6 billion in cash is astronomically higher than the value of 6 billion in inventory. If you want to look at Costco's, assets or Walmart's assets, proportionally, so much more of their company is tied up into company assets, property, plant, and equipment, right? It's it's things that you can't monetize outside of the continued operation of the company. And so the company's pigeonholed. It's just another way that they have less financial clarity for their future, less financial stability than, say, a GameStop, who any day of the week, if they want to use these assets to generate alpha, they can. And so their book is that much more valuable, right? Because it's, even if you don't believe in Ryan Cohen or you don't believe in their ability to utilize this cash, which you should, but even if you didn't, a buyer would. If I was going to take it over, I'm going to get at least that much in value, right? And I would much rather have cash than stores that are maybe unprofitable that I got to figure out, and how many auto zones are we going to keep and how many are we going to close, right? The type of assets is another factor that someone could consider in terms of how do you value the book of someone's business. And the more liquid those assets, the more valuable that book becomes, rather than fixed assets that are tied up into strictly the way that they're currently being operated. So from a price to book basis, I mean, it's just hard to imagine GameStop being worth any less than it is. It is um, dramatically undervalued by the public eye, for sure. And truthfully, it's probably not a fundamental undervaluation by institutions so much as it is an artificial suppression by institutions, or short selling, right, by institutions. And that short selling likely is not tied to their evaluation of the current business, although it could be. It's almost surely tied to short sales that were made years ago before Ryan Cohen even bought into the business, and certainly well before they reached this point in their company transformation, that are still open, that have yet to be closed. And that open interest is another topic for another video. But I say that just to say, if you're thinking, why? How could it be that this company, if Jeremy says it's so great, how could their price to book be so low? And it's probably not some fundamental piece that you're not seeing right. It's probably just, oh, this is an undervalued opportunity. This is artificially being kept here in a sense because it has to, or else it could go all the way to here, right? If enough movement happens quickly enough, then you get momentum traders in there. We'll save it for another video. We'll keep going at it. But GameStop is not a meme stock. It is a real company with real prospects. And man, from a price to book basis, you're telling me that they're what, 6 times cheaper than just the industry average with a more efficient asset utilization, a higher liquidity of assets, and a higher clarity of their financial future and of their industry's future. Woo! It's a good time to hold some shares. So the downside, pretty low, right? How much lower could it be? And the upside, well, you saw it, 3,000% just from a price to book basis. We'll look at some other ways to value this company in some future videos, but hopefully you learned something. If you have any questions, drop a comment below, or again, just join in my free community at jeremybr.com. Would love to meet you and would love to help you. All right, we'll talk to you soon.